What's going on, my fellow wealth creators? Matty Guys here. In this video, I want to answer the question, is private money lending risky? And the reason I want to answer this question is because personally, I don't think it's very risky at all when you know what you're doing. We're going to talk about that. But it's also become one of my favorite ways of building wealth in real estate. It's passive. You can make great returns. It's secured by a hard, tangible asset. Typically, real estate is much less volatile than things like the stock market. And when you start putting all the pieces of the puzzle together and you start learning how something like private lending actually works, you realize that it's not nearly as risky as what a lot of people would make it out to be, or as what it might sound like, right? Because when you hear private lending, you think to yourself maybe something along the lines of, well, so what you're saying is I'm going to lend a significant portion of my hard-earned money to a complete stranger halfway across the country to do a real estate deal? Well, that just sounds dumb, very irresponsible, very risky, right? And if you stop there, I suppose there's an argument for that. Fortunately, that's not the case, and it's far less risky than a lot of people think. Certainly than what I originally thought as well. And I'm very grateful that I started going down this journey of just exploring alternative ways of building wealth outside of the what I now refer to as the investing industrial complex, quoted by one of my mentors, Mark Moss, the other day in one of his videos. If you guys don't follow him, absolutely go subscribe to his channel. He's fantastic, great content. But he calls it the investing industrial complex. It's basically what I would normally refer to as mainstream financial planning system, whatever, where, they try to fit everybody in the same box. It's a one size fits all strategy where, you go to school, get a bunch of student loan debt, you get the job, and then you max out your 401k. And then in 30, 40 years, life's going to be good. You're going to be a millionaire on paper and you'll be able to live your golden years. The problem is the actual results, the numbers from that strategy don't look good. They're not very appealing to me at all. I want nothing to do with it. And it's just not in alignment with my goals and my values and beliefs and how I want to build wealth. And I just don't think it's a very effective, efficient way of building wealth. And there are alternative ways of doing so that I think if people were exposed to, they would at least explore. Now, again, that doesn't mean that people shouldn't invest in a 401k. I'm not saying that. This is not financial advice. I'm just sharing my experience. And it's not to say that private lending is a good fit for everybody, or infinite banking, velocity banking, like all these alternative methods of accelerating the wealth building process in our lives that I have come to find to be very, very powerful. But we're not taught these things. And I think it's because it goes against the investing industrial complex, where the things that we are taught are not actually in our best interest. They're much more in the interest of Wall Street and government and financial planners. Because if you think about it, with what we're taught to do, maxing out 401ks and stuff, who takes on all the risk, but yet continues to get paid for the life of the account? Well, Wall Street, your financial advisors aren't taking any of the risk. You are. You're putting your money in, hard-earned money into the market, and then you're paying these management fees that they get paid regardless of whether the account performs or not. And they continue to get paid on that account, as long as the account is under management. So that's a guarantee, almost a guaranteed income stream for Wall Street. And then when it comes to government, they're going to get their fair share of your hard-earned money and your investments when you start to make withdrawals on that. And it's interesting because when I ask people, do you think taxes are going up in the future, or you think they're going down in the future? Most people think they're going up. So why on earth would you defer the tax to a later time if you think taxes are going up? That just doesn't make any sense to me, right? But anyways, I digress. But my point of saying that is that what we're normally taught to do by the investing industrial complex is not always in our best interest. Maybe it is sometimes for the right people. Okay, I'm not saying that 401ks are necessarily bad, but are they the most efficient way to reach our goals? Well, if you start looking at other options, like in this example, private lending, they might not be the best way to reach our financial goals, right? And at the end of the day, why I make this type of content is because I want people to do their own research. I want you guys to explore these different options, and so you can determine whether or not something makes sense or not. right? See, when I started learning about private lending, it became a no-brainer to me. Like it was in perfect alignment with where I'm at in my life right now, with focusing on building my business, creating content. So do I really want to be doing fix and flips and all that stuff and wholesaling and being super active in real estate? Not really, not at the moment, but that doesn't mean I can't invest in real estate. There's lots of different ways to do it. And so I had this capital that I saved up. I put it into my infinite banking policies, right? I've done tons of content on that. And then I borrow against them, lend it out at far more than what the policy loan interest is. And I'm basically printing money at that point. I'm acting like the bank. And I think it's a fantastic way to build wealth. So that's what I want to address today. And I want to go through a couple of slides here. All right, talk about some specific points. Again, just talking about whether or not private money lending is risky or not. To some people who don't know what they're doing, it's absolutely going to be very risky, but it's just like anything else. The more educated you become, the more knowledge you have about something, the more mentorship you have, the better, when you have a professional team that you've built, whatever, you significantly lower the amount of risk involved in whatever that wealth building strategy is or that investment is, right? So the real question is what makes something risky? And for me, it's a lack of education that truly makes most things risky, because in most cases, the more educated we are, the less risky something becomes. I heard this from a mentor of mine a long time ago where he said, there aren't risky investments, there's risky investors. And the risk comes from not knowing what the heck you're doing. So I'm going to give a couple of examples here. One of them is stock trading. So for me, if you were to ask me, is stock trading risky? I would say yes, because I don't really know much about it. It's not in alignment with where I'm at in my current situation. And like I said, I wouldn't know the first thing about trading stocks. But does that mean stock trading is risky? Well, I think it depends on who you ask. So for example, Gareth Soloway, one of the other mentors that I follow, which I highly recommend that you go subscribe to his channel as well. Very, very successful trader. Wasn't always successful, right? Definitely made his mistakes, but he is a super successful trader, even though he doesn't, I don't think anybody has a 100% win rate on their stock trading, but because of the system that he's developed, due to the education and experience that he is a very successful stock trader. And if you were to ask him, is stock trading risky? I think he would say something very similar. Well, it depends. Like, do you know what you're doing or not? Right? Do you have the system? Do you follow the system? Because when you follow a proven system, is it as anywhere near risky as somebody that doesn't know what they're doing, who's trying to do it? No. Right. So you start to significantly lower and mitigate risk in whatever it is that you're doing with the knowledge that you acquire about it, the educational process that you go through, the training, the mentorship, asking questions, developing your network, whatever, all these things play a massive part in determining how much risk is involved with what you're doing. Another example would be like when Warren Buffett invests billions of dollars into a company to take a major ownership stake in it. Is that a risky move? When I hear that sounds pretty risky. You're dumping billions of dollars into this company. Like, what happens if something goes wrong and it doesn't pan out, whatever. But Warren Buffett knows what he's doing. He has the team in place. He has the experience, the knowledge, education. So when he makes moves, he's making very calculated decisions, educated, informed decisions. He has a very specific way of doing it. So to him and his team, it's not very risky because they know what they're doing, right? So those are just a couple of examples. Specific to private lending, here's a couple of basic things that you should really know before you ever pull the trigger on a private money deal. Otherwise, it is very risky, okay? But when you know these types of things, now all of a sudden the risk is far less, okay? Do you know the difference between first and second lien positions? Okay, this is something that I learned. I had no idea about when I first got into private money lending. All right, but for the least amount of risk possible, you always want to be in first lien position. That's basically what the bank would be. So when you get a mortgage on your home, if you stop making the mortgage payments, what happens? Well, the bank comes in, forecloses on the property, sells it, and recoups their money. So it's pretty rare that the bank is going to lose money in that scenario. It's not the ideal scenario that they want to go through. They'd rather you just make your mortgage payments, but they significantly reduce their risk by being in a first lien position so that if they have to foreclose, they can recoup their money. Okay. as opposed to a second lien position, which you'll typically make higher returns, but you're taking on more risk, because if the deal goes south and investors don't get paid and the property has to be foreclosed on, if there's not enough money made in that deal, you might not get your money back. So there's a lot more risk. Okay. So it's just something to be aware of, right? So people get so fixated on the rate of return and, oh, it's secured by real estate or whatever. Okay. But if it's a second lien position, that's something you need to be aware of. You're second in line for getting your money back if the deal goes south. Okay. Very important to know. 70% loan to value. Do you know that the more, like the higher that number, the more risk you're taking? You typically don't want to go above 70% loan to value. And I'm going to give you an example of this here in a second. All right. But if you don't know that and you lend money to the point where it's 80% loan to value, well, now you're injecting more risk into the deal because there's not enough wiggle room there, right? Rehab draw requests, another way to significantly lower your risk, especially when you're working with newer investors. All right. Do you know that, especially with a major rehab project, do you really want to be giving $50,000, $60,000, $70,000 of rehab money up front to the investor after the purchase to do these rehabs? Or should we maybe break that up as the project progresses, right? So where they have to make draw requests from a third-party company, usually a title company, in order to get the money they need for this particular part of the rehab. That significantly lowers your risk. Okay. Now, as you work with investors more, you get more experience with them. They have really good track record. Maybe you do this, maybe you don't. Okay. Every situation is a little bit different, but it's important to understand, right? And these are just a few of the basic things that you'll want to know. If you guys are interested in getting the exact step-by-step blueprint that I went through for becoming a private lender, I will link that down below. There's a discount code as well. The course is super cheap, guys, compared to what we're doing here. And the code will give you 10% off. It is literally start to finish how to become a private money lender. All the exactly what the process looks like from start to finish, all the documents involved, how to protect yourself, etc. It is phenomenal. I've gone through it like 10 times now. It's incredible. Anyways, let's break down a little bit of my first deal. So I lent $135,000 for the purchase and the rehab. So it was $110,000 for the purchase, and then there's $25,000 for rehab. And the rehab was pretty minor. No major rehab project was necessary. There's a lot of cosmetic stuff. So it ended up being a 67% loan to value. So after running comps and stuff, they said it was worth about $201,000. I actually ran my numbers as if it were $191,000 after repairs, just to give myself more wiggle room. That was just under 70% loan to value. And I'm in a first lien position. Okay, so again, I'm the bank here. If for whatever reason the investor does not pay me back, I can foreclose on the property. I can take over the deal myself. I could sell it to another investor to recoup my money. I might even be able to make more money than I would have if the deal just went through like it was supposed to. So my risk is I'm protected. Okay. Very, very minimal risk here if something were to go wrong. And like this is actually recorded in the public record, guys. It's not like it's just a document between myself and the investor. This is actually public record recording, just like you would when you're buying a home. Okay. I also got a personal guarantee from the investor as well. So we don't lend money to individuals. We lend our money to LLCs, corporations, etc. But we can also get a personal guarantee from the investor so that if the deal does go south, I can come after the investor himself because I have that personal guarantee. That's another way of lowering risk. And anybody that's willing to give a personal guarantee is probably pretty confident in their ability to do what they do. And this was a very experienced investor. I'm skipping around a little bit here, but that's another way to reduce risk, as well as work with somebody that knows what they're doing. Preferably if you can get a referral from another lender who has worked with the investor, has been successful with them. They've done lots of transactions successfully. They've never lost investors' money before. They've always paid back their investors. You're now lowering your risk. You're working with somebody who has experience. And that's exactly what happened with my first deal. I was introduced to this investor by a mentor of mine who has lent over $1 million to this person. This person has done tens of millions of dollars of real estate transactions successfully, has never lost investor money. I feel pretty confident in that deal. All right. Plus, he gave me a personal guarantee. So I lent the money at 12% interest. I did not do points on my first deal because I want the experience. I'm definitely doing points from here on out because that is a major profit center for private money lenders. And you want to be compensated for, the risk that you are taking, obviously. And the point is basically 1% of whatever the total loan amount is. Typically, you're going to do 1 to 2 points per transaction. So that can really add up. So that was my first deal, and it's actually pending sale right now. So it's going to be completed here very shortly. It was on, I think they only had it after they rehabbed it. They had it on the market for, I think it was less than 7 days, and they had it under contract. So it's pending sale right now. So it's going to be done very soon. Very excited. And then we're moving on to our second deal. It is awesome. But here's why. Here's some specific reasons why I personally don't think private money lending is risky. It's secured by a tangible asset. It's secured by the property, guys. And if you think about, like when we start comparing it to other asset classes, other investment strategies, is your mutual funds, is the stocks you're invested in, like, is that secured by anything? Is that secured by a tangible asset? Not really. I mean, you do have ownership. Technically, you have ownership in the company, but if you read the fine print in the brokerage statement, a lot of the times the stock is owed to you. You don't actually own it yet. So you're at the mercy of the brokerage firm to actually give you what you think you own. Anyways, that's a different story. What I'm saying is stocks aren't really secured by anything. And the value just, fluctuates. Maybe you get dividends. That's great. But with real estate, it's like there's an actual hard asset that I can take possession of to recoup my money if I needed to. To me, that reduces so much of the risk. Again, especially when you're in a first lien position. Okay, low volatility. Traditionally speaking, historically speaking, real estate is far less volatile than things like the stock market. The valuations of property does not fluctuate nearly as much as something like the stock market, for example. 70% loan to value maximum. Again, just keeping our risk very low. We have a lot of wiggle room. If something does go wrong, we have a lot of potential equity to play with, to recoup our investment if we need to. Building a professional team, right? Having, the real estate attorneys, the title companies, contractors, lawyers, things like that in place to help mitigate the risk. Insurance agents as well, having that's kind of the next point, is covered by insurance. So you want to make sure you're on the insurance policy. Maybe get a title insurance policy as well, depending on who you're working with. All right, in case an issue comes up with title. Obviously, if the building burns to the ground, right, you want to make sure you're protected that way. So having a good insurance agent to go over the insurance policy, make sure you're protected properly. That mitigates a ton of risk as well. And all that's paid for by the investor, not you. Draw request, like I said, not giving, $50,000 of rehab money up front, unless, you work with the investor a ton. You guys have done a lot of business together. The job's going to get done. All right. Every situation a little bit different, but especially, with major rehab projects, somebody, doesn't have a massive track record, or you don't have a ton of experience with. Do we really want to be giving all that money up front for the rehab, or do we want to break it up as the project progresses? Something to consider. We get great returns as well. We're definitely compensated for the minimal amount of risk that we are taking. 12% plus points. That's pretty good. That beats for me, that beats the stock market all day long. Like, why on earth would I invest in the stock market and lock my money up for 30 to 40 years when I can do 12% or more per year in real estate passively? Like, I'm just lending the money. They're doing all the work, all the marketing, all the rehab, all the, they're handling the sale of the property. I'm just providing the funds. That's pretty sweet. I'm not going to make as much as them on the deal, and that's fine. They should make more than me because they're putting a lot more time and energy and effort into it, right? But I'm still making really good money on this passively. Great returns, guys. And you're in control of the process as well. Like, you determine who you work with and what deals you lend on, at what terms and conditions, what interest rate, right? How many points, how long, the duration of the deal. Like, you are in full control because you're the bank. You dictate what happens with your money in this particular type of strategy. So I'll go ahead and wrap up with that, guys. That's why I'm such a huge fan of private lending. I think when you take the time to educate yourself and you know what you're doing, it is not anywhere near as risky as people think it is, and it can be a fantastic way to build wealth passively as well, right? Because again, we're just lending the money. The investor's doing all the work. And man, you find a couple of really good investors with great track records. I mean, you just do deals over and over and over again. Like my investor constantly has deals that he needs funding for. And I can just repeat the process over and over and over again. Why on earth would we not do that? So again, it's not for everybody. Totally get that. But I think it's at least worth exploring because it can be a game changer and just a fantastic way to build wealth. So I hope this was helpful, guys. If you have any questions whatsoever, please drop them down in the comments section below. I would also love to hear your feedback. If you have any experience with private lending, what are your thoughts about it? Would love to hear your thoughts on it. And like I said, I will link down below to the exact step-by-step blueprint that I went through learning how to be a private money lender. I'll have a discount code for you guys as well if you're interested in doing this. The key is just to get educated. Know what you're doing. All right. I spent 6 months learning, going through that blueprint over and over and over again, learning the language and terminology and all the documents involved and everything before I even started looking at deals. And then I hired a mentor to review the deals that I did start looking at. And I actually said no to my first 2 deals that were presented to me because my mentor saw things and pointed things out that I missed. Right. So when it comes to stuff like this, guys, it's the education is priceless. The mentorship is priceless because it's going to help you avoid the mistakes and make sure that you do it right. Okay? So anyways, I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.